Hi, everyone. Welcome to today's Brown Bag. We have Trevor, who is our VP of Finance here at Lambda. He's going to be talking about equity compensation. So I'm going to go ahead and pass it over to him to introduce himself and get started.
All right. Thank you, Bree. Hello, everybody. My name is Trevor McKendrick. I'm the VP of Finance here at Lambda. Just a quick background on me. I have a degree in accounting, and I worked at a big accounting firm called KPMG out of the Bay Area. Quit that, and then I started a small iPhone app company. Had the #1 Spanish language Bible app in the App Store that did pretty well. I sold that at the end of 2015. If you Google atheist Bible salesman, my name pops up. And I've been with Lambda for about 4 months now. And we're going to be talking about stock options and equity compensation today. So I'm going to go ahead and share my screen with you, and we will jump right in. Can you all see that? I will assume yes. All right, so stock options 101. I kind of have the feeling that a lot of times we know or we hear like what a stock option is, but a lot of people like don't exactly know what that even means. So I have a fun clip from Seinfeld I wanted to play.
Hey, what happened to my stereo? It's all smashed up.
That's right. Now it looks like it was broken during shipping, and I insured it for $400.
But you were supposed to get me a refund.
You can't get a refund. Your warranty expired 2 years ago.
So we're going to make the post office pay for my new stereo now?
It's a write-off for them.
How is it a write-off?
They just write it off.
Write it off what?
Jerry, all these big companies, they write off everything.
You don't even know what a write-off is.
Do you?
No, I don't.
But they do. And they're the ones writing it off.
Anyway, I feel that a lot of times we are the same way about stock options. It's something that we talk about, we hear about, but we don't actually tangibly know what it is. So we're going to talk about that today. Options come in basically two building blocks. The first part is the exercise price. So an option is the right to buy a share of stocks, and the exercise price is how much you have to pay the company to get the share of stock. And then the other half is the expiration date. So there's like a window of time that you have to exercise the option. So let's say you get an offer letter, you're really excited to work with this company, and they say, hey, we'd like to give you, $70,000 in shares, $70,000 in salary and 10,000 stock options. Stock options, like what does that even mean? How much is it worth? So let's dive into that today. First of all, always assume they're going to be worth zero. Stock options, especially in most companies, especially private companies, are going to be really risky. They're not liquid, so they're not, you can't sell them. So don't bank on them or assume that they're going to be worth something. Just assume they're going to be zero for starters. And the actual value, but the way the actual value is determined has a couple different building blocks. So you have the stock price of the company, which is different from the option price, just to be clear. But you have the stock price of the company, which is what you're going to be getting when you exercise an option. And then you have the strike price of the option, which remember is what you pay for the option. The price that you pay to change your option into a share. And then the gap is the actual value of the option. It's like the profit of the option. So, so maybe that's not very useful because, so how do you know if a company offers you 10,000 shares, or 10,000 options, what's the strike price of those options and what's the stock price? These are, and I know this sounds really, technical or jargony, but it's really important to be able to know these things, to be able to figure out the value of your options. And if you're kind of like, I'm not into this, I've noted the questions that you should ask potential employers in green throughout the presentation, and they're numbered. So if that's, one of the things you can take away is actionable, is like, okay, these are the questions that I know I should ask my employer so that I can figure out what the value of the options actually are. So we'll keep going. So one, we're going to talk about how do you find out what the stock price is of a private company, and then how do you find out the strike price of the options. So first of all, we'll do the stock price. You might have heard, I'm sure you've heard companies that, they raise, $10 million at $100 million valuation. That valuation is what's going to determine the stock price. So say some company raises their valuation is worth $250 million, and they have 10 million fully diluted shares outstanding, then their share price is going to be $25 per share. And these are the questions you would ask your employer. You would ask, what's the post-money valuation in the last fundraise? That's going to be the numerator. And then how many shares, or what's the count of fully diluted shares outstanding? A lot of companies might not give you the second question, but it's still definitely worth asking, and at least having something to bargain with. Some companies will hold it pretty close to their chest because they don't want to give out how many shares are outstanding, because it reveals the price of the shares. But once you have those two numbers, then you can easily figure out what the price per share is. And I just made these numbers up here, but we're going to be assuming in this example that share price is $25. The share price is $25. So that's the stock price. What's the strike price? Strike price is what you pay for the option. That's all you have to remember about what strike price is. And when you do make that exchange, it's called exercising the option, and it's based on fair market value, FMV. And what is the fair market value based on? Well, if you're a private company, it's based on the last, what's called a 409A valuation. And just to compare, so like if you're a public company, fair market value would just be whatever the public stock price is. You could look it up online easily, wherever stock prices are listed. But for a private company, since there's no listing, you have to, the IRS requires companies to get what's called a 409A valuation. And all of 409A is you pay a consultant to come back and say, hey, here's the price of your shares. So they come back with the price per share, and that is the strike price. It's as simple as that. So, and how often does it change for a private company? About once a year, or as often as every time they do a fundraise. So now you probably ask, well, is the fair market value, the FMV of a private company, the same as the stock price? No, for reasons that aren't super important, but just know that they're not the same. The fair market value, or the 409A price, is generally going to be a lot lower. So the third question you should ask your employer is, what was the last 409A share price? And this is going to be super important, because remember, this determines the strike price of your options. And in this case, again, I'm just making these numbers up. We're going to say it's $5 per share. So we have the stock price of $25. We have the strike price of $5. We know the gap is what their option is going to be worth, so $20. As a side note, because I know we're talking about share prices right now, but people tend to think in like percentages of like, what percent of the company do I own? Like if I hear that the company's, a company sells for $100 million and I own 1% of that, I get $1 million. And so, it's very easy and very rational to think in terms of like percent of the pie. So as an example, if you have 10,000 shares and there's 10 million shares outstanding, you'd own 0.1% of the company, which, by the way, if you're an employee and you're not very early, if you're not like one of the first 10 employees, that would be a lot of equity, just kind of as a benchmark. Just a kind of a side note, and I'll get to talking about the percent of the company that you own a little bit later. So another question that's really important to ask is how long do you have to exercise your options? Sometimes people make the mistake of, they leave the job and they think they have as long as they want to exercise their options, and the options end up expiring and they lose out on them. That happened to someone here, not while they were at Lambda, but at a previous employer. It happened to an employee at Lambda where they were Googling how to exercise my options, and they figured out that they couldn't anymore because they had expired. So the question you'd ask is, what is the exercise window? And this varies from employer to employer, but it's usually 30 days or 90 days. Not like 30 to 90, but 30 or 90. But at some places, it can be as long, I think at Coinbase, it's like 10 years. So it varies a lot, but generally it's going to be 30 or 90 days. And that's as of the date of your termination. So whether you leave the company for whatever reason or they fire you, it's going to be probably 30 to 90 days. When can I exercise my options? Like, when are they mine? So you've probably heard of vesting before. So that's what this is. So if you start with a company, they'll say, hey, we're going to give you 10,000 options, and they're going to vest over 4 years is a very typical vesting schedule. And that just means 4 years with a 1-year cliff, which means in 1 year, 1 year after you've been after you started with the company, you get a fourth of the options, and then every month after that, you get another, it's like 1/48 for the remaining of the 3 years. So at the end of the 4 years, you will have, you'll own all of your options, and then you can exercise them. Very common question or things that people don't realize is, they say, I got 0.1% of the company when I started. And what they don't realize is as the company goes on and raises more money from investors, their percent ownership of the company goes down. So if you start with 0.1%, when the company exits in 5 years, you might have a much smaller percent of the company. This can sometimes surprise people. And what this is called dilution. So just as an example, if you start with 10,000 shares, and your company raises more money, your share count's going to stay the same, but the shares outstanding is going to go up. And, I'm making up 10 to 20 million, but when you bring on more investors, the way, they give you money, they give the company money, and the company gives them literally creates shares and gives them shares. And so the number of shares goes up. And so your ownership percentage might, in this case, go from, 0.1% to 0.05%. And a lot of people are like, what the hell, man? Like, you can't, you just taking my equity away, or you just, how can that happen? And well, it's not a conspiracy. It's not like a bad thing. What actually happens is the company is now worth more. And so the pie is now bigger, which means that your percent, while smaller, is going to be worth more than before the fundraise. So in this case, if you own 1% and the company was worth 250 million, those options would have been worth 250K. Now you own 0.05% of, and let's say the new valuation 750 million. Now it's worth 375K. So your percent is smaller, but the value is bigger. That's important to remember. Something that's out of scope for today, but is super important, is the tax implications. Taxes get really complicated with options about like when you exercise and whether it's capital gains or ordinary income. And so I have a couple of highly recommended blog posts that don't talk about just taxes, but just options in general that I think everyone here should read if they're going to be, accepting options from their employers. And I'm going to post this whole presentation afterwards, so you guys can go and find out. You can find these links. Anyways, I know that's a lot to cover, so I'm going to just jump into Slack now. And if anyone has any questions, I would be happy to take them. I heard Michael Jordan made a fortune by choosing to have most of his Nike nerves pay off in the form of Nike stock or stock options. Yeah, stories like that are true, at least some of them. But the stories you never hear about are the ones where they took a bunch of options or a bunch of equity and then it ended up being worth nothing. So it can go up or it can go down. Our stock price is only available for public companies. Basically, yes. So you can look up the stock price of any public company. The stock price, private companies have stock prices too, but those tend to be held very close to the chest. A lot of times only the owners know about them. Or in some places, some startups, they share the price regularly. Like here at Lambda, I just did a presentation last week where I shared the stock price of Lambda stock. So it depends, but generally it's going to be with public companies. Is it pretty normal for employee stock options to be diluted? Yes, that is totally normal. It happens every time. Every single time you hear that a company has raised money from investors, everyone, not just the employees, but the previous investors, they were all diluted. Is it better for a company to take PE money or VC money? Highly dependent on the situation of the company. In the social network, why was the CFO so mad at Mark? Seemed he was diluted out of ownership and all money. We should be careful to judge reality based on movies that are made by Hollywood that are meant to entertain and get our emotions riled up. Because if you actually look at what went down with the co-founder of Facebook, he like hijacked the bank account and the company like literally couldn't move forward because he was kind of holding the company hostage. Anyways, is exercising an option simply the ability to sell your stock? Exercising an option is, so like you have an option and you don't have a share. And the option will say the exercise price is $50. And so what that means is I'm going to pay the company $50 and give them this option. And in exchange for the $50, they're going to give me a genuine share of the company. So it's kind of turning your option into the ability to, well, not really. It's exchanging the option for ownership in the company. And then once you have the share, then you can sell the stock on a, assuming the company's public, then you can sell the share just like you would any other public stock. How do you research the value of the shares if startups are not public? Do you just ask? That's a very good question, Andrew. Yes. You just have to ask the company. And like I said, some companies will be happy to share that. Some companies won't. It just depends. Travis asks, if the company is offering options, can you sell the option on the market, or do you need to exercise the option with the company and then sell the shares? That is a good question. It depends. Some companies will have what are called secondary offerings or like secondary shares. So like what happens, for example, right now with like Uber employees. So Uber is still private. But their valuation has gone up a ton. So their employees' options are worth a lot of money, but there's like no immediate way to sell them. And so sometimes companies will let their employees exercise their options and then sell the shares before they go public. It also depends on the company, though. Question, just Paul, sorry if this is irrelevant, but how do we use money from our equity to pay for Lambda's ISA? Is it a relatively liquid asset? Generally, no. Stock options are incredibly illiquid assets. So the only way you would use them to pay for Lambda's ISA is the same way you would use them to pay for anything. You have to convert them to cash. And the way you do that is by exercising the option, which would turn it into a share, and then selling the share on the market. Kat asks, what is the average dilution of a company during a seed round? It varies a lot. For a seed round, it can be 10%, it can be 30%. It varies a lot. Brian asks, there's been a recent trend for companies to be semi-private. An example of this is Uber. This tends to hurt employees' options because they do not have access to this private market to sell their shares. Do you see this trend continuing? I am not in the business of predicting anything about anything in the world because it's very complicated. But it depends on the company. Some companies are, will let their employees sell their shares in secondary offerings. Like Twitter, I don't know if Twitter did this on purpose because Twitter was so disorganized, but Twitter employees were definitely able to sell their shares before Twitter went public. What is the typical percent allocation for a CTO, assuming the CTO is employee number 5 or sooner? Again, it varies on the situation. There's nothing typical about this. It's going to depend on your relationship with the other founders or with the founders if you're an employee. It's really going to depend on what your specific value to the company is. It can be anywhere from, a couple of points, so 1% or 2%, or it can be, 20, 30, 40, 50, as much as the founder. So it just depends. Is stock options part of the equation in calculating how much we owe to Lambda School? No, it is not. So once, well, I take that back a little bit. It almost never will be. It only would be in the case, because it takes so long for stock options to become liquid. It would only contribute if you were to have the option and stay at the company long enough to exercise it and then sell the share, and then that was part of your income in your tax return. So but most people are going to have their ISAs already paid off at that point. There's one response to that. Thanks for asking. Okay, yeah. I know there's some points in the chat. Oh, nope, those have been covered. Okay. I know that was a lot of information really fast. The takeaway though is that most employees, even people who've been in startups for a long time, just don't ask these questions, and so they kind of they're afraid to ask, or they're not sure what to ask. And so the best thing you can do is just be informed and ask those questions and do just a little bit of research on your own. And that would put you ahead of a lot of, I would say, most employees. Because as good as, a lot of founders are, I think most founders are very good people. A lot of times this information isn't, a lot of people, they just don't even think about it. It's not that they don't want to share it. It's just not, they're so busy and they're doing so many crazy things. They just want to get the person onboarded as fast as possible. And if they happen to ask the question, they're like, oh yeah, I can get you that information. Like, no big deal. But if you don't bring it up, it might not even occur to them. Ooh, several people are typing. So exciting. When exercising the stock option, does the money you pay to buy the stock, is that tax deductible? No, it is not. How should we, Clint asked, I know you said something like assume equity is worth 0 until it's not, but how should we judge whether an offer that includes equity is good or not? That's a really good question, Clint. It depends on the kind of the point in time of the company in its life cycle. So like, how big is it? How quickly is it growing? How early of an employee hire are you? And the number of options or the percent of the company that you get in those time frame in each part of the life cycle are going to be very different. And so what I do is I ask around, I ask my friends, I Google to see what is normal at other startups. After a certain point, though, I would say that you shouldn't be basing the value of the options as the percent of the company, but you should be based on like the dollar value. And so that's kind of what I presented about today. And that is what I would use kind of as your gauge. It's like, well, I'm getting this much in salary. Let's say it's the $70K in salary. If I'm getting, $200K in options vested over 4 years, that's $50K more a year. Like, is that $50K worth it to me, knowing that it's, it's unlikely to turn into anything? I don't know if that answers your question, but there you go. Travis asks, if you've been holding options for a public company for 2 years and decide to exercise, then sell the stock, is that taxed as long-term capital gains or short-term? Or is it taxed as a standard part of your income? Let me read that again. Hold an option for a public company for 2 years and decide to exercise. So the question is, when is it a capital gain? So when you sell the actual share, for it to be a capital gain, you had to have held the share for at least 1 year. In this case, that means you would have had to exercise the option, and then you have the share, and then hold on to the share for at least a year. And there is a couple more details that go into it. And so I would read the third blog post that I linked to that gets into more details about this type of question. But for it to be a long-term capital gain, you have to hold the share for at least a year. The share, not the option, the share. Is this something our career coaches are trained on? That's a good question. I don't know. I will ask them about that. Noah, good question. Is there a non-dilutable type of stock that a company can issue that we can request? No. That is not a thing, because having the dilution is based on the total number of shares, right? And so if a company ever raises more money and has to give away or has to give out more shares, then you're going to be diluted automatically. Now, there are an employee can never get this. This is not something you should ask for because it would make you look clueless. But there are provisions that some very late stage investors ask for, where they say, if our shares get diluted, we want to be issued more shares to make up for the dilution. So that is a thing that some investors do, and that will happen in what's called in a down round. So like if a company raises at a valuation of 100 million and then a year later they raise at 50 million, so the shares are worth less. Investors have provisions to get more shares to make up for that. But employees would never ever get something like that. And I would recommend don't ask for it, because it would make you just look amateur. Travis, following up on the capital gain question. If the company offers the option to sell the option without exercising and you hold that for over a year, would that be taxed? To my knowledge, I don't think that happens. It might, being able to sell the options, but my understanding is that you always have to exercise the option. Though if you see something different, let me know. You're welcome, Travis. You're telling me, Travis. Yeah, if you want the 15% tax bracket, you just gotta hold on for as long as possible. Vim asks, are options negotiable? If so, any suggestions on how to maximize without sacrificing salary? Yeah, I mean, everything is negotiable technically when you're an employee or when you're considering an offer. You can always ask for more, to whoever's question it was earlier about the career coaches, that they'll have better advice for you on this than I would. But you can always ask for more. They say one number, just go back. Oh, that sounds great, and go back with a bigger number. But yeah, Bree is right. We should defer to Courtney on this. Do you think Lambda owners would ever consider going public a few years out? Yes. I mean, it'll be a long time. I think today or this month, Lambda's been around for 18 months, so a year and a half. So we got a long ways to go before we go public. Most companies don't go public until at least year 7 or year 10 or even later. So we got a long ways to go. This is a really good question that I didn't cover. Vim asks, in startups, is there a way to get straight equity and not the option to buy equity? The reason that no, and the reason generally, almost always no. And the reason for this is because if they gave you straight equity, like if the startup gave you stock instead of options, the stock, giving you stock would be taxable. So you would have to pay taxes on the stock, even though the stock is not liquid and you have no cash to pay for the taxes. So if someone gave you, stock that's worth $100,000, that'd be like getting paid a salary of $100,000. You have to pay taxes on it, but you have no money to pay the taxes. So that's like the whole reason that options exist for startups. It's just kind of an end around the tax code to help employees out on this. Let's see here. Thank you, Clint, for buying in Lambda stock once we go public. I appreciate that. Oh, one of our employees is typing. Ryan, what you got for me? Or maybe you're adding to the discussion. I shouldn't assume you're asking me a question. What's the difference between RSUs and stock options? I thought RSUs were like getting straight equity. Yes, that's what I was getting at when I said almost always they're not going to give you straight equity. The exception is RSUs. RSU stands for restricted stock unit. Because this was like an options 101 presentation, I didn't go into like the different types of options or equity. But everything I talked about today was for options that are called ISOs. And you can read about this in the first blog post that I linked to. There's differences between all these things, but one of the main differences is how they are taxed. And so you'll see RSUs are typically given out by companies that are still private, but that are much bigger. So like Facebook, when they were getting really big, started issuing RSUs instead of options. And then public companies will also sometimes issue RSUs instead of options. Can employees get preferred instead of common? No. That would be great if we could, but no, we get common shares. What Vim is asking about is, so there's common shares and then there's preferred shares, and preferred shares are what investors buy, and they give them certain additional rights, like, maybe, well, it depends, but rights like whether they can be on the board or different provisions where they can, if the company sells, the preferred shareholders get their investment out of the company first before common shareholders get money and things like that. But no, employees get common. Are stock options transferable or only in certain instances? I don't believe so. I'm fairly certain. I'd have to double check on this, Adam, but I believe you have to exercise before you can sell. I assume that's what you mean by transferable, is whether you can like sell or transfer to other people. But yeah, generally they have to be shares. Vim, it can be. It can be a pretty good gig being an investor. So I asked, can you resell the stock option in the open market? Can you resell the stock option in the open market, assuming the company is public? Can you resell employee options? I don't know the answer to that. I'd have to actually look it up. I don't think so. I think they put in provisions about not letting employees do that, but I'm not sure. I'll look into that and get back to you. Ryan asks, so as an oversimplified rule of thumb, if I'm interviewing at FANG companies, can I think of, are you interviewing with FANG companies, Ryan? What are you doing, man? You're supposed to stay here at Lambda with us. If I'm interviewing at FANG companies, can I think of RSUs as being equivalent to cash? But if I'm hypothetical question, right, Amy? But if I'm interviewing at startups, I'd safer to assume the stock options are worth zero. Yes, I would put like a discount on the RSUs to being cash. But yes, that's a fair, generous, pretty. If you were giving out RSUs, they're probably pretty close to cash. Yeah, man. Ryan's been here less time than I have. So if he's already interviewing in other places, that's not a good sign. Ryan says he lives in Central Illinois. He's not going anywhere. I mean, I hear some of the FANG companies have remote offices, remote employees too. Yeah, Ryan points out that just trying to advise students, and most FANGs are not remote friendly, which is true. Yes, the more you know. I'm just giving you a hard time. These are totally fair questions. 10 more minutes for questions. Yeah, you'll hear lots of fun stories about how people took options or equity in lieu of something. So like the Priceline, was it William Shatner? Is that the guy's name? The Star Trek guy who did the Priceline commercials? He took equity instead of salary. And so he ended up, I don't know how much he's worth. He's worth at least like 9 figures now because of that. There's also, is it Dave Cho, I think? He did an awesome podcast with Dave Chang, the chef, like a month or two ago. So Dave Cho is like this famous artist guy. He's like semi-insane, but he's very interesting, very cool life. And he did the graffiti at the entrances of one of Facebook's first offices. And he's like super high-risk guy. He's a gambler. Yeah, here it is. And so he sits down with Sean Parker to do this painting. And Sean Parker, co-founder of Facebook's like, Ed, do you want cash or do you want options? And Dave's like, I'm a gambler. Just give me options. And then 8 years later, Sean has another sit down with him. He's like, so you're never going to have to worry about money for the rest of your life, right? Because his equity is worth, I don't even know, it's like 9 figures or something. It's great. Yeah, 200 million or something crazy. I'm not saying these are recommended courses of action because, again, these are the 2% stories that you hear. You never hear about people that take equity and it ends up being worthless. Excuse me. Are ISOs preferred over NSOs? It depends. I would read, I think it's the second article that I linked to. Vim, how many people give you a hard time that your name is the same as Vim? I am not the first. All the time. I'm so sorry, man. I mean, that's great. I mean, I hope when you apply, they were just like, Vim, you're in. Welcome to Lambda School. When is Lambda going to start a graffiti course? As soon as you can pay down ISAs based on your graffiti. If someone can do that, we're happy to offer a graffiti course. You're in, but you can't exit. Yeah, Vim, you cannot quit Lambda School. That would totally destroy the premise of your name. I have to learn. I like, yeah. Every time I get into Vim, I'm like, why? I'm the finance guy, but I do plenty of coding on my own too. And every time I end up in Vim for one reason or another, I'm like, God damn it, get me out of here. Any other questions? Tom Tarpey in the UK is typing. Tom Tarpey, is that? I'm really bad at British accents. Way to disappoint me. Tom. Clint asks, how does Lambda handle ownership of lab projects? Anything, I'm speaking off the top of my head, but as far as I know, anything you build for yourself is yours. I don't see why we would want, I mean, I think like we want to be able to like show people like your work and stuff, but if you were to like take it and spin it off, and I mean, it's yours. You coded it. It's yours. Vim asks, would you be laughed at if you asked for the cap table as one of the first employees? If you're one of like the very first employees, no. I think that would be a reasonable question. You would just, because you would, when you're asking for equity, that, and I'm talking about like first 5 employees, maybe first 10. Yeah, you want to know, less the cap table, and you just want to know the kind of the same questions I was talking about before, but just in more detail. So like, who have you raised from, at what valuations, who owns what percent? So, who are the main interested players in the startup? I think that's fair as long as there's fewer than, 5 or 10 employees. This is slightly off topic, but related to Clint's question. Has Lambda ever considered helping students to incubate a startup idea and then take a stake in the startup as a form of ISA payment? No. And if that idea were suggested internally, I would try and shut it down very quickly because most startups aren't worth anything. Most startups' equity ends up being worth 0. So it wouldn't be a good way, a very certain way of paying down ISAs, A, and B, I think students tend to learn a lot more when they're working with other people that are more experienced in an actual role instead of like forming a startup amongst each other and trying to like keep on coding. I mean, that can be a lot of fun, but if you want to get like good as a developer or at any craft, I think it's good. It's best to get into the workplace as soon as possible. You just learn so much more when you're working with experienced people. I mean, yeah. Is it possible to quantify most as like 80% or 99%? Regarding what, Vim? What did I say most about? Oh, it's a high number. I don't know if anyone has the precise data. I'd say 95% plus. It's just so hard if you're doing a startup to make any reasonable money. Do private company stocks typically issue dividends? That's another good question. Some do. It depends. The vast majority, I would say 99.9% of startups, even like successful startups that have cash, do not do this. But some kind of more, I don't know, call them old school or companies that have been around for a while that are still private, that just have a lot of cash, will do they'll do dividends to their shareholders, or they might do profit sharing with their employees. It depends, but in like the tech startup space, typically no. Now, I mean, it depends on the industry. In startup land, no. They're not going to be doing dividends or stuff like that. They might do bonuses. If they're really big, they might do. If they've been around for a long time, they might do profit sharing. But most like the tech startup you've heard of, no. I'm thinking of like older companies. Like my buddy works at an investment firm that's been around since the 80s. Maybe there's 10 owners. They're super disgustingly profitable. Like 9 figures of profit every year. And so he owns like a small percent of it, and they'll issue a dividend like once a quarter. But it's kind of rare. Adam and Patrick are typing. Have you ever heard of a company offering to buy back options from employees? Yes, this does happen. Where I need to look up the details again. But yes, sometimes companies will want to decrease the number of shares outstanding by buying back shares or buying back options from their employees. Patrick says, reminds me of the author who penned the Witcher series. Decided to take a lump sum rather than the option to be paid based on how well the game does. And now he's kicking himself. Yeah. You never know. That's the whole point, is you don't get the upside without the risk. If it wasn't risky, they wouldn't be offering it to you. Like, the fact that it's available is a sign that it's risky. But then sometimes, risk is very adequately, compensated. Any more questions? Algunas preguntas? Oh, looks like Bree's shutting it down, guys. Maybe not. We'll see what she says. All right. Thank you very much. It was fun chatting, everybody. If you have other questions about equity stuff, option stuff, feel free to DM me, or anything finance related, whether it's ISAs or Lambda stuff, or if you're a PM getting paid, any of that stuff. Always feel free to DM me directly. So yeah, it's been fun talking. Thank you.
Awesome. Thanks so much, Trevor. Everyone have a good rest of your day. Bye.